I think the single most important thing to know in the forex market is you have to know who moves the market. The only way you can be profitable is if you're trading with the institutions that move price. There's two ways to do this. You can either trade institutional price concepts, which means stop using the retail concepts that most traders use, which is the 90%, which is support, resistance, and candlestick patterns. Those are the two things that most retail traders use most. And another way to do it is by trading like the daily time frame, because that way you get to filter out all the price manipulations that happen on the lower time frames. So even if you're using indicators, if you're trading on the higher time frames, like many people that trade no-nonsense forex type algorithms, they are able to be profitable because they ignore the lower time frame market manipulation. I'm going to be explaining why I don't use support and resistance and why it doesn't work. I'm going to be showing you how I take trades using institutional concepts. So one thing that you should remember is in the forex market, the total volume is about $5.6 trillion per day. Per day, this is the biggest financial market in the world. And because of that, the price movements are not random. People won't let that much money move randomly. In order for people to make money, other people have to give up their money, lose money, and that's why there's less than 10% of profitable traders. In order for you to make money, you have to trade like the 10% and not like the 5% that are like the 90% that are losing their money. So you want to trade like the institutions that move the market, the big banks like Barclays, not like hedge funds. There are many small hedge funds and many small banks that also don't trade like the bigger banks. So I'm going to be showing you how support and resistance levels get violated by the market makers. So here we have a support level. This is a support level that most retail traders would have identified. And then what happens is price comes, breaks through the level. So anybody who is buying here now gets stopped out before price continues to move up. And everybody who's selling here, because they see a breakout, they also get stopped out because price immediately reverses back up. So price has taken out both the buyers and the sellers before continuing to the downside. What we have here, we have another support level. Some people might be looking at this as a double top or a double bottom. What happens, price comes, taps into the level multiple times before violating the level. Everybody who's buying, everybody who's selling gets taken out, hits their stop loss before price continues down. Everybody who buys this as a breakout, probably on the lower time frame, price begins to move in that direction before reversing to the downside. You might even look at these as minor support levels. Price just breaks through. Again, price develops. If you're looking at this as a support level, even though there's only one touch, price just breaks through. Another thing is people use support and resistance levels with candlesticks. Like here you see, okay, there's a support level there, there's a doji candlestick, so that's a buy. Price breaks through immediately after that. Price moves up. There's a whole bunch of levels that people might identify here, or zones. And then here's the prime example that I identified. So here is a very clear support level, so resistance level, and here's a very clear support level. And what does price do? You'll notice that price tests this level multiple times, and it actually works a few times. Price tests that level, but you'll probably only be able to notice it on the third touch, because you can't take one touch, and some people don't take two touches, but this is a clear double top, so you could take that. But price comes and tests this level, and then it moves down correctively, and price immediately violates the level. That should take out everybody who is selling this area and drops. And you can see that this move isn't fueled by retail traders. This move is fueled by institutional traders because they move the market. Only they can move the market like this. And then notice what happens on the other side as well. After violating the resistance level, price comes and violates this support level, takes everybody who is buying out of the market, and if people want to sell the breakout, they also get taken out, and then price moves in the original direction. And price comes and tests this order block before moving down and then moves up again. But I just want you to notice how price violates both the resistance and the support levels. Now I'm going to be showing you how I took a trade based on the violation of this support level on the 15-minute time frame. So what we had after price violated the support level was obviously liquidity got filled, which is orders, people's stop losses, and then price moved upwards. I'm just going to play this out. So what happened here was price made an uptrend. Here we have a high forming, a lower high, and then we broke this structure, creating a higher high. So now we know that we're in an uptrend. Within that uptrend, price formed an order block. Then I went down to the 5-minute time frame, and I saw the trend was clearer. So what we had here was on the 5-minute time frame was this was a downtrend, this became a lower high, this was a lower low, and then price broke, making this an uptrend. Then price formed another high, another low, and price broke these highs. And then I marked out the 5-minute order block, which is this level, because that's where the move originated. All the buys came from this move while the price was moving downwards. There's also this order block within that one, so I could expand this to include both, and we have this imbalance area with insufficient price action. So I placed my buy stop at the top of that institutional order block, and all I had to do was wait for price to retrace into that level. So price taps into the order block, taps into it a few more times, and then continues up. So what happens here is price comes to this level, and because of this you could move your stop loss to break even, because that would be your first target, which would be then the previous high, although I like my targets at the wicks right at the top of the candles. So again, price moved impulsively. This would be another order block if price would retrace into this level, but I'm not going to take that because I'm already in a trade, and that would be close to break even. And price forms another higher high and continues the uptrend. So now you'd be trailing a stop below the lows. You could trail a stop after the high breaks. You could trail a stop below that one. There's high breaks, you can trail a stop below that one. Then you'd potentially be taken out because price broke below this previous high. But if you watch how this trade, so that would be 1-4 risk reward, the simple setup, so that would be 4% if you risk 1%. But if you watch how this trade played out, if you're trading a stop below there, price impulsed and continued to move to the upside. And you can see that that move was also funded by big institutions and not retail traders, and price just continued to move up. If you're trading this as a resistance level, your stop loss would have been violated. And price continues to the upside. But one thing that is important to note is support and resistance can be used to make a profitable trading system as long as you have a good risk-reward ratio, risk management plan, trade management plan, and a good strike rate. In the long term, basically all trading strategies are profitable.